Hey guys, traders normally combine multiple time frames to get a more accurate analysis and a better entry. However, if you apply all the trading concepts from monthly time frames to lower ones, your chart will likely look like this, which is confusing and useless. So, is there any way to combine multiple time frames and still have a simple and clear analysis that is actually helpful and not confusing? Yes, there is, and that is the topic of this video. Today, we are going to explain what top-down analysis is, why it is important, and show you our technique to do it the right way. By the end of this video, you will know exactly which time frames to combine and how to apply price action and smart money concepts on each time frame. So guys, thank you for hitting the like button and for sharing your thoughts in the comments. What is top-down analysis? Top-down analysis means starting chart analysis with higher time frames, like weekly and daily, and then moving down to smaller details, like 4-hour, 1-hour, and 15-minute, to get a more accurate analysis. Now, why is top-down analysis so important? Top-down analysis is important because it helps you understand the market conditions better before you take any trade. When you start from higher time frames, you can clearly see the overall trend, strong levels of market structure. Then, when you move down to lower time frames, you can find cleaner entries and avoid trades that go against the bigger picture. In short, it keeps you on the right side of the market, reduces bad trades, and gives you more confidence in your decisions. For example, here we have a clear downtrend on the 15-minute chart. Placing a short trade on a pullback might look like a great idea to follow the trend. However, if we check the 4-hour time frame, we can see that the price has reached a key market structure level. This means there is a higher chance that the price will react to this level, making you question whether the short trade is still a good idea. On the contrary, here we have an uptrend on the 1-hour time frame. If we switch to the daily time frame, we can see that there is still plenty of space before the price reaches the next key level. So, when we go back to the 1-hour chart, we can open a long trading setup confidently and target the daily structure. In the third trading example, we have a consolidation on the 5-minute chart, where the price looks trapped inside a box. A break to either side could signal the next move. However, if we zoom out to the 1-hour chart, we can see that the higher time frame direction is actually bullish. This means we should focus only on buying, since the overall trend is bullish. If the price breaks below the range, there is a higher chance that it will end up being a failed breakout. If the price returns back inside the range, we can look for long entries aligned with the higher time frame direction. In another trading example, we have a pullback to a